Welcome to Talk Tickers. Today we are breaking down the first quarter earnings for Darden Restaurants, that's ticker DRI. The report came out before the market opened on September 18th, and boy, did the market react. Let's dive right in.
So right out of the gate, the market was not happy. The stock took a pretty significant hit, down about 9%. Now that might seem kind of strange, right? Especially when you look at what seemed like really strong sales numbers. So what's the disconnect here? Well, that's exactly the story we're going to unpack.
All right, so here's how we're going to tackle this, just like an analyst would. We'll start with those headline numbers, then we'll dig into management strategy, unpack the one big thing that's spooking investors, look at their outlook for the rest of the year, and then we'll wrap it all up with our take on the stock.
Okay, first up, the beat and the miss. The most important thing to get here is that this was really a split decision, a classic tale of two tapes.
So on one hand, you've got the top line, their revenue, which actually squeaked by with a small beat. We're talking just over $3 billion, up a really healthy 10.4% from last year. But, and this is the big but, the bottom line, their profit, that's where they hit a snag. Adjusted earnings per share came in a few cents below what Wall Street was expecting. Now, it's not a massive miss, but any miss at all tends to get the market nervous. Now, the real engine behind that strong revenue number was their same restaurant sales. And that's a super important metric in this industry. They were up a blended 4.7%. And you can see here that growth was driven by really impressive performances of their big brands, Olive Garden and LongHorn Steakhouse. Clearly, what they're doing is working with customers. So let's talk about that strategy. How are they pulling this off? Because this isn't just luck. You can see a very clear plan in action. And honestly, the execution is strong.
On the earnings call, the CEO, Rick Cardenas, really framed the quarter as a big win. He pointed directly to what they called their brilliant with the basics playbook. It's their core philosophy, focus on great food, top-notch service, and just a good atmosphere. That's what drives the business.
And this wasn't just some high-level corporate talk either. They gave us the specifics. For instance, their partnership with Uber Direct, that's successfully bringing in younger, wealthier customers through delivery. To hit that affordability angle, they're testing lighter portions at Olive Garden. Then you've got these compelling limited-time offers, like the Hawaiian sirloin at Cheddar's, driving value. And they're not sleeping on menu innovation either. It's a really smart multi-pronged attack to win over all kinds of different customers. Okay, so strong sales, a smart strategy that's clearly working. So what gives? Why did the stock get absolutely hammered? Well, the answer isn't on the sales side of the ledger. It's all about costs. And this table right here, this tells the whole story. Management had to raise its inflation outlook for the entire year. And the real killer, the absolute pain point, is commodities. They're now flagging high single-digit inflation for beef and seafood, which is going to hit really hard for the next couple of quarters. And of course, that directly impacts a brand like LongHorn, where steak is the star of the show. And what this creates is a classic margin squeeze. You see, Darden has built its brand on offering value and keeping its prices below the rate of inflation. But when the cost of your core ingredients, like beef, just skyrockets like this, it puts an immense amount of pressure on your profit margins. Which brings us to the million-dollar question, right? This is the very reason the stock dropped 9%. Can Darden's fantastic operations and their smart pricing strategy actually absorb this inflationary punch without it totally derailing their earnings for the rest of the year? The market, at least for now, seems pretty skeptical. Okay, let's look at what management is officially forecasting for the full year, because this is where you can really see that margin squeeze playing out in the numbers. So, check this out. They actually raised their sales forecast. That's a good sign. It shows they're confident in the top line. But, and here is the kicker, they kept their earnings per share guidance completely flat. What does that tell you? It's a huge signal to investors that every single dollar of that extra revenue is expected to get completely eaten up by higher costs. And they were super clear about this. They didn't try to hide it. Management basically put up a big flashing warning sign for Wall Street saying, hey, get ready for the second quarter. They're expecting Q2 to be the absolute low point for earnings growth this year, precisely because that's when this beef inflation is going to hit their bottom line the hardest. All right, so let's put all the pieces together. What is our call on Darden from here? After a report like this, where do we think the stock is headed?
So our official rating on the stock is market perform. Essentially what that means is we think the stock is priced about right for now. There's this real balance, this tug-of-war between some clear strengths and some pretty significant short-term challenges.
And this slide really sums up that tug-of-war. The bull case, the optimistic view, is all about their execution. I mean, it is fantastic. Their value focus is working, and they're great at returning cash to shareholders. But then you have the bear case, which is all about that inflation monster lurking in the background, just ready to eat up their margins. And with tougher comparisons coming up later in the year, the path for the stock really depends on which of these two stories wins out.
And of course, just a final reminder for everyone, this is not financial advice.